When an asset rises more than 140% in a single cycle, it's never just about price. It's about something breaking underneath. Today, silver is trading near $72 per ounce, levels that few imagined possible just 1 year ago. To put this in perspective, at the beginning of the last cycle, silver was quoted at approximately $30 per ounce. In just 12 months, it recorded a historic appreciation that surprised even the most experienced analysts. This isn't normal appreciation. This is the type of movement that precedes fundamental transformations in the global system. If you observe carefully the trajectory of precious metals throughout history, you'll realize there's a pattern that repeats with almost mathematical precision. Silver doesn't move alone. It never has. When we see silver more than doubling in value in a single year, as happened recently, we're not simply witnessing the appreciation of a commodity. We're observing a thermometer that measures the temperature of the global financial system. And today, that thermometer isn't just indicating fever. It's marking temperatures we haven't seen since the 1,970 seconds. Silver is rising because something fundamental has changed in investors' perception of the future. It's not speculation. It's not a fad. It's a logical consequence of economic forces that if you understand the incentives, become predictable. The most visible catalyst has been growing discussions about Chinese restrictions on silver exports. Considering that China controls between 60% and 70% of global refined silver supply, even rumors about possible export controls sent shockwaves through all global markets. But these geopolitical discussions are just the symptom. The disease runs much deeper. Over the last 50 years, I've studied more than 500 years of economic cycles. I've analyzed the fall of empires, the rise of new powers, periods of hyperinflation, economic depressions, and currency wars. And in all those moments of transition, absolutely all of them, precious metals served as refuge for those who understood the system was changing. What we're seeing today with silver is no different. It's the same pattern repeating once more. The difference is that this time, ordinary Americans are facing a situation their parents and grandparents never faced. The loss of absolute confidence in the US dollar as a store of value, combined with a crisis in physical precious metal supplies that didn't exist in previous crises. And when confidence in a currency begins to deteriorate at the same time that strategic resources become scarce, precious metals don't rise by accident. They explode in value because they represent something paper money cannot offer: real scarcity and intrinsic value, independent of government promises. History is an excellent teacher, and it teaches us that all major movements in silver were connected to moments of stress in the global monetary system. In 1971, when Nixon removed the dollar from the gold standard, silver was quoted at approximately $1.50 per ounce. In less than a decade, it had reached over $50. It wasn't coincidence. It was the natural market response to systematic devaluation of the world's reserve currency. During the confidence crisis of the 1,970 seconds, when American inflation reached double digits and the term stagflation entered the economic vocabulary, precious metals became the last refuge of value for those who understood the monetary system was being redesigned. In the 2008 financial crisis, when century-old banks disappeared in a matter of weeks and governments began printing money on scales never seen in history, again, we saw silver multiply in value. And today, we're experiencing something even more significant. In the last year, silver recorded its best performance since 1979, an anomalous movement that surprised even market veterans. To put this in perspective, this means every $10,000 invested in silver at the beginning of the last cycle was worth more than $24,000 at year's end. For the first time in modern history, we have a combination of factors that didn't exist in any of the previous crises. An unprecedented physical supply crisis. During 5 consecutive years, global demand for silver exceeded total supply, including mining and recycling. In the last 12 months, demand reached 1.24 billion ounces, while total supply was only 1.01 billion ounces. Structural deficit, demand versus supply. A Federal Reserve that cut rates 3 times consecutively recently, even with inflation persisting above the 2% target. The most recent data shows inflation around 2.75%, a level that historically would require restrictive, not expansionary monetary policy. And more critically, a rival power that decided to use natural resources as a geopolitical weapon. If you observe the data coldly, you'll see we're not facing a normal situation that can be resolved with traditional economic policy tools. We're facing a system where artificial liquidity meets real physical scarcity. And when that happens, 2 things can occur. Either the system transforms radically or it collapses. Silver is rising because institutional investors, those who manage trillions of dollars and have access to the world's best information, are positioning for both possibilities. To understand why silver's rise signals systemic instability, you need to understand 3 fundamental principles that govern all economic cycles. The first is the dynamic of real scarcity versus artificial scarcity. What we're seeing with silver today is different from any previous crisis because we're facing real physical scarcity, not just financial manipulation. During 5 consecutive years, the world consumed more silver than it produced. The accumulated deficit is simply astronomical. 230 million ounce deficit. In the last cycle alone, the deficit was approximately 230 million ounces, one of the largest in modern history. But here's what makes this even more critical. Industrial demand for silver exploded due to the technological revolution. Solar panels, electric vehicles, 5G infrastructure, semiconductors, artificial intelligence applications, all these technologies depend intensively on silver. The difference between silver and other metals is that it possesses a unique characteristic. Besides being a monetary metal, it's also industrially indispensable. You can't make an efficient solar panel without silver. You can't manufacture advanced AI chips without silver. When you combine growing physical scarcity with inelastic industrial demand and expanding monetary demand, you get the recipe for explosive price movements. Industry technology leaders have already publicly warned about silver's criticality in modern industrial processes. When a power that controls 70% of global supply decides to restrict exports, this isn't just a commercial problem, it's a national security crisis. The second principle is the impossible mathematics of current monetary policy. The Federal Reserve cut rates 3 times recently, even with inflation persisting above the 2% target. The most recent data shows inflation at approximately 2.75%, a level that historically would require restrictive policy. But here's the dilemma. The Fed can't raise rates significantly because that would break the American government under the weight of its debt. And they can't keep rates low indefinitely because that feeds even more inflation. This is the debt trap that Austrian economists predicted decades ago. When a government becomes indebted beyond its payment capacity, it gets trapped between 2 bad options: explicit default or inflationary default. Explicit default is politically impossible for countries that issue reserve currencies. This leaves only inflationary default, deliberate currency devaluation, to reduce the real weight of debts. Silver is anticipating this devaluation, and institutional investors know it. The third principle is the transformation of natural resources into geopolitical weapons. We're experiencing something that happens only once per century: the transfer of global economic power from one dominant power to another. China's decision to discuss restrictions on silver exports isn't an isolated commercial move. It's part of a coordinated strategy that includes restrictions on rare earths, tungsten, antimony, and other critical materials. China understood something fundamental. In the modern economy, whoever controls critical resources controls the industrial future. And they're using this control as geopolitical leverage. Chart. London stock decline, silver stocks in London traditionally the center of global precious metals trade, fell from 31,023 metric tons in June 2022 to just 22,126 tons in March of last year, a drop of almost 30% in less than 3 years. Let me tell a story that perfectly illustrates how these principles work in practice. Imagine a prosperous city where, for decades, everyone used the local currency issued by the city's central bank. This currency worked perfectly while the city grew and prospered. But then, gradually, things began to change. The city began spending more than it collected. To finance its spending, the central bank began printing more local currency. At first, nobody noticed. Inflation was low, jobs were secure, everything seemed normal. But some more astute merchants began noticing they needed more and more units of local currency to buy the same amount of goods from neighboring cities. Slowly, these merchants began accepting silver as payment, not because they had something against local currency, but because they recognized that silver maintained its purchasing power more consistently. When other merchants realized this, demand for silver increased. And when demand for silver increased, its price in local currency began rising. The more silver rose, the more people questioned the real value of local currency. And the more people questioned local currency, the more they sought alternatives like silver. This is exactly the dynamic we're seeing today, but on a global scale. The US dollar is the local currency of our story. And countries like China and Russia are the astute merchants who began seeking alternatives. The difference is that this time we're talking about trillions of dollars in international reserves that can potentially migrate to alternative assets. To completely understand the magnitude of what we're experiencing, you need to understand that the last year was a historic inflection point, and today marks the beginning of a new era. In January of the previous year, silver was quoted at approximately $30 per ounce. 12 months later, it had reached levels near $72, more than doubling its value. But numbers tell only part of the story. What really changed in the last cycle was the fundamental dynamic between supply and demand. For the fifth consecutive time, the world consumed more silver than it produced. The deficit of 230 million ounces was one of the largest in modern history. And for the first time, this deficit couldn't be compensated by existing stocks. During the last year, discussions about possible Chinese restrictions on silver exports intensified. The simple possibility that China, which controls 60-70% of global supply, might restrict exports was sufficient to add a significant geopolitical risk premium to silver's price. Within weeks of these rumors gaining strength, silver jumped from approximately $65 to over $72 per ounce, not due to speculation, but because traders finally understood the risk that a massive portion of global supply could be effectively removed from the market. While silver exploded in value, the Federal Reserve continued its contradictory policy of cutting rates even with inflation persisting above its 2% target. In December of last year, the Fed cut rates for the third consecutive time, bringing them to the 3.5 to 3.75% range. But 3 of the 12 FOMC members dissented, 1 preferring a larger cut, 2 preferring no cut. This internal division reveals the impossibility of the situation. The Fed can't raise rates significantly because that would break the government under the weight of its debts, but they also can't continue cutting rates indefinitely with inflation at 2.75%. Now, let me explain what this means for you as an ordinary American concerned with your financial security. If you're 45 years old and planning to retire at 65, you need to understand that the economic environment of the next 20 years will be fundamentally different from the last 20 years. During the last 40 years, you could count on 3 things: low and controlled inflation, relatively stable economic growth, and a strong dollar that maintained its global purchasing power. These 3 conditions are changing simultaneously. Despite 3 consecutive rate cuts recently, inflation remains stubbornly at 2.75%, well above the Federal Reserve's 2% target. And that's just the official number. If you calculate inflation using 1,980 seconds metrics, real inflation is probably between 6% and 8% annually. This means if you have $500,000 saved today, in 10 years, that money will have the purchasing power of approximately $250,000 to $300,000 in today's dollars. Your retirement plan probably assumes $1 million in 2045 will have approximately the same purchasing power as $400,000 today based on 3% annual inflation. But if we're entering a period of persistently higher inflation, say 6% per year, then $1 million in 2045 will be worth approximately $180,000 in today's dollars. The difference is catastrophic for any traditional retirement plan. The classic 60/40 portfolio worked magnificently during the last 40 years of falling interest rates. But when interest rates are rising and inflation is accelerating, both stocks and bonds can perform poorly simultaneously. In the last complete cycle, while the S&P 500 rose approximately 20%, silver rose 148%. In other words, for every dollar gained in stocks, silver investors gained more than $7. This wasn't luck. It was the logical result of understanding we're in a fundamental transition in the global economic system. During periods of high inflation, real assets tend to preserve purchasing power better than financial assets. Silver's performance in the last cycle was a clear demonstration of this principle in action. Silver isn't a speculative bet. It's insurance against monetary devaluation that's already underway. Based on the principles we've discussed, diversification doesn't simply mean distributing your investments among different stocks and bonds. It means distributing among different asset classes that respond differently to the same economic events. If you have $500,000 in retirement assets, consider an allocation that includes stocks of companies with real pricing power, real estate in locations that will maintain value during economic stress, commodities, including precious metals, and some international assets. Silver can represent 5 to 10% of that allocation. Not as speculation, but as insurance. Don't try to predict when the crisis will happen. That's impossible. Instead, position yourself for different possible scenarios. If the current system stabilizes, a small position in silver won't hurt your total returns. If we enter a period of prolonged high inflation, positions in real assets like silver will protect your purchasing power. If the current monetary system enters severe crisis, precious metals could be your best performers. The logic is simple. Prepare for what can go wrong, not just what you hope will go right. To completely understand why silver's rise signals profound structural changes, you need to understand the mathematics behind global monetary transformation. Today, total global debt is approximately $350 trillion. Global GDP is approximately $100 trillion. This means a debt GDP ratio of 3, 5 to 1. To put this in perspective, if a family with $100,000 annual income had $350,000 in debt, it would be technically insolvent. When central banks maintain artificially low interest rates, they create massive distortions in capital allocation. Companies that should fail continue operating. Unproductive investments continue receiving financing. Speculative bubbles form in financial assets. The result is an economy that appears healthy on the surface but is fundamentally fragile inside. Monetary history offers clear lessons. The last year taught us something fundamental about how systemic crises develop. For years, experts said silver deficits were manageable and stocks were adequate, until they weren't. The lesson is that complex systems don't fail linearly. They deteriorate gradually and then collapse suddenly. The Fed is financing government deficits through monetary expansion today. Official inflation is moderate at 2.75%, but growing. And smart money is silently migrating to real assets like precious metals. Today, we see a pattern similar to the 1,970 seconds. The United States is financing massive deficits through monetary expansion. Other countries are questioning the sustainability of the current system, and they're accumulating alternatives like gold and silver. What made the last year unique was the introduction of resource nationalism as an economic policy weapon. This wasn't unexpected for those who understand history. What's new is the sophistication with which it's being executed. The lesson for America is clear. Economic sovereignty requires resource sovereignty. To completely understand silver's potential, you must understand we're only at the beginning of a technological revolution that will multiply its industrial demand. Explosive AI growth is creating unprecedented demand for advanced semiconductors. Each AI chip requires silver for optimal conductivity. Solar panel production is experiencing exponential growth. Each solar panel requires approximately 20 grams of silver. With global solar capacity expected to quadruple by 2030, this represents approximately 1 billion ounces of additional silver demand, more than current annual mining production. Electric vehicles use 15-20% more silver than traditional vehicles. 5G infrastructure requires substantially more silver than previous technology. Medical applications increasingly incorporate silver due to its antimicrobial properties. What makes these applications significant is that silver is largely irreplaceable in high-performance applications. This creates inelastic demand, demand that persists even as prices rise. If you have children or grandchildren, teach them about real assets versus financial assets. A generation that grew up during American hegemony needs to understand that geopolitical dominance isn't permanent. The most important skill is long-term thinking. In a world of instant gratification, the capacity to think in decades becomes competitive advantage. The silver rally that culminated recently from $30 to over $72 per ounce isn't an isolated event. It's a symptom of fundamental transformations redefining the global economic order. For 80 years, we've lived under a monetary system that depended on American supremacy. But systems have life cycles. The mathematics of global debt, the unsustainability of current monetary policies, and the emergence of challenging powers is converging to force a transformation of the international monetary system. The facts are incontestable. For 5 consecutive years, the world consumed more silver than it produced. The accumulated deficit is massive. China has demonstrated growing willingness to use critical resources as geopolitical tools. The Federal Reserve cut rates 3 times recently, with inflation at 2.75%, well above target. Silver recorded its best performance since 1979, with appreciation that put all other traditional investments in the shadow. Silver stocks in London reached their lowest levels in decades. These aren't opinions or theories. They're measurable facts anyone can verify. This transformation can happen gradually over decades, or it can happen rapidly in response to a catalyzing event. We can't predict the exact timing, but we can observe the patterns that historically preceded such transformations, and silver's movement from $30 to $72 plus is exactly that type of pattern. This doesn't mean you should panic or make extreme decisions. It means you should recognize a reality. The world your children will inherit will be fundamentally different from the world you grew up in. And in that new world, the skills that will be most valuable won't be the ability to predict short-term market movements, but the wisdom to understand long-term cycles and the discipline to position for multiple possible outcomes. Silver is telling us that smart money is positioning for change. The question isn't whether change will come. Change always comes. The question is whether you'll be prepared when it happens. If you observe carefully how the pieces are moving on the global chessboard, you'll see we're in the initial stages of a transition that historians will remember as a decisive moment in the evolution of the international monetary system. The silver rally isn't the end, it's just the beginning. It's an early warning signal that those who understand cycles and patterns can recognize and act upon. At this exact moment, with silver above $72 per ounce and growing geopolitical concerns about critical supplies, we're witnessing history being made in real time. History is an excellent teacher, and it teaches us that those who understand these patterns and position appropriately are rewarded for their patience and wisdom. Those who ignore patterns or hope this time is different typically pay a high price. The choice, as always, is yours. But the consequences of that choice will unfold over the coming decades, regardless of whether you recognize them or not. Reality doesn't negotiate with our preferences. Reality simply is. And the reality is that the global monetary system is in transition. Silver hitting $72 plus per ounce is telling you that. Discussions about Chinese restrictions are telling you that. The Fed's contradictory policy is telling you that. The question is, are you listening? Because if you are, there's still time to position. But windows of opportunity don't remain open indefinitely. And this window is closing. Monetary crises don't warn. They reveal themselves first in assets the system can't control.